Hello and welcome to this Astranti video on Chapter 1 of the BA3 study text, The Purpose of Financial Reporting. So what are the different sections we're going to cover in our video today? So we're going to start by looking at what financial reporting actually is. We'll then move on and look at what a business is, before looking at who actually does this financial reporting that we're talking about. Our fourth section will look at who actually uses financial statements, which are the products of financial reporting. We'll then look at the different elements of these financial statements before concluding our video today by looking at the specific types of financial statements that you'll come across in your CIMA studies. So what actually is financial reporting? Well, the first thing to say is that financial reporting has been around almost as long as civilization itself. So I want you for a moment to take yourself back to ancient Egypt and picture in your mind the construction of one of Egypt's famous pyramids. Building a pyramid of this size is a monumental undertaking. And the Egyptians at the time would have needed methods to record the costs and expenses and the amount of money that they were spending constructing this pyramid in the first place. And the systems that they used to manage these enormous costs associated with this pyramid construction would in principle be similar in nature to the accounting systems that are used by businesses in the modern world. And so essentially, accounting or financial reporting is the measuring, processing and communication of financial information. So part of the reason societies such as the ancient Egyptians were able to build monuments like the pyramid was because they had systems in place to manage and organise the wealth that they had accumulated through processes like trading. And this concept is very similar to those applied in modern business. A huge multinational corporation, for instance, will be undertaking hundreds and thousands of different transactions. And so what they need is a process to organise and increase the efficiency of the recording of these transactions. And what this allows them to do then is identify specific financial patterns to cut through the plethora of transactions they've undertaken and recognise areas, for instance, where they're doing really well, where they're particularly profitable, and these areas can then be capitalised on. Essentially, by using these systems, businesses can identify where their money is made, and this helps them therefore capitalise on this and make more money from those sources. And so there are two types of accounting which you need to be aware of over the course of your CIMA studies. The first of these is management accounting. So management accounting deals with the internal preparation of internal information. And this information then goes to the management of a company who use it to inform their decision making about where to take the company. So if management is using this information to help them make decisions about a company, what sort of qualities is it important that this information holds? So some of the key qualities of management accounting information is that it must be relevant to the decision that the manager is making, and it also must be up to date in nature. If, for instance, a company's director is trying to make a decision on a new product type to release, information on the depreciation of the company's warehouse, for instance, isn't relevant information which will help them make this decision. And it is these types of decisions that management accounting information really concerns itself with and really contributes towards things such as which new products shall we select, where shall we sell these new products, which consumer bases shall we aim to target. And the ultimate result of management accounting and the information that it utilises are things such as budgets, investment appraisals, and product and customer analysis. Now this contrasts starkly with financial accounting, and financial accounting is the focus not only of this video but the focus of the entirety of this BA3 syllabus. And so, unlike the internally focused management accounting, financial accounting deals with the presentation of information to external parties. And so, what are these external parties that might use the information derived from financial accounting? Now, there could be a range of different groups or parties, but organisations such as banks and a company's shareholders are perhaps two of the key external parties that financial accounting is directed towards. And the key idea of financial accounting is that the information that it presents to these external parties must be objective, it must be transparent, it must be clear, and crucially, it must be accurate. So for instance, if you put yourselves in the shoes of a bank, if you're going to lend a substantial amount of money to a company, what do you want to know about said company? Well, really the key things you'd want to know is, can that company actually repay the liability, the potential loan that you are willing to give it? And how do you find out that information? Well, that is where financial accounting comes into play. A similar idea applies to a company's shareholders or potential shareholders. You wouldn't want to invest in a company whose financial statements or financial accounting information show you that it is a loss-making entity who is experiencing cash flow difficulties, for instance. And these financial statements which I've just measured are the end result, the end point of financial accounting information. So financial reporting has a number of key aspects, key processes, key parts of it, if you will, that we need to be aware of before we move forward. And the first of these fundamental aspects is the recording of data. Now, I wonder if you can guess what this particular section might deal with. Well, unsurprisingly, this is with regards to how organisations keep track of transactions and organise these transactions in a useful manner. So imagine that you own a small shop, for instance, an antique bookstore, for instance. How do you record the amount of books that you sell to consumers? How do you record the amount of inventory that you purchase to sell on to consumers? How do you record the amount of books that are returned to you by customers unsatisfied with their purchase? Well, the answer is that you record data relating to each of these different aspects of the business. So for instance, whenever you make a sale, you will record this transaction so you have a record of it later on. And the idea of recording data is fundamental to financial reporting. It is a key facet of the subject. And this is no matter what size business you run. So from the smallest sole trader all the way up to our multinational corporation with its hundreds and thousands of different transactions, recording data is key. The next important consideration is, how do you measure this data that you've just been recording? The key point about measuring data is that this should be done in a standard and repeatable measure. So for instance, if you have 3 different members of staff who record data in an organisation, there is no value in each of these 3 members of staff recording data using different processes which provide different results. Another useful example to consider this idea by is that of valuing a company car. So say for instance you purchase a car and several years later you want to re-measure the value of your car. Now there are a number of different avenues open to businesses. Different depreciation policies, for instance. Do you use the historic cost or the revaluation model? Or quite simply, do you look at a similar model car, assess its value, and then take your revaluation measurement based on this? So as I'm sure you can see, there are a number of different methods open to businesses. And what's really important is that a business chooses a single method and applies this as a standard and repeatable measurement throughout the entirety of its business to ensure consistency. And a way for consistency and standard approaches to be applied throughout the entirety of an industry, for example, is through the use of accounting standards. Now, these aren't universally applied, but what they do is they give you guidance on specific, for instance, depreciation policies to use in specific situations. And a standard approach to measuring transactions therefore means that things such as financial statements, which are the end product of our financial reporting, are more consistent, and this ensures that they are both objective and also comparable between businesses or between industries. And sorry, that's just a slightly late reveal of the objectivity and comparability point. Another key aspect of financial reporting is the presentation of information, and it is crucial that financial information is presented in a useful and a meaningful manner. So if you think of an investor looking to invest in a particular company, they're not going to want to trawl through the company's entire recent financial history. They're going to want to see the key metrics, the key figures that are going to influence their decision whether or not to invest in said company. And part of this presentation idea is that information should be both accurate and relevant. And I'm sure that you can get an idea of why this might be the case for our investor. If an investor is going to invest a huge amount of money in a business based on financial information that they have assessed, they want to ensure that this financial information is accurate and is completely relevant to the decision that they are making. Essentially, they don't want to have been misled into making their decision. And finally, financial reporting information or financial information. It should be a summary. It should summarize the range of transactions that a business has been involved in and present an overriding view of these. Efficiency is a key idea here. You want to be making an efficient summary of the range of transactions that people have been involved in with your company, so that when someone like an investor looks at it, they can actually benefit from this information. So if you consider for a minute, if you go to a bank and you apply a bank loan, would the bank clerk, the bank manager who you are applying for this loan from, be very happy if you produced a whole stack of receipts and evidence of financial transactions? The answer is, of course, they wouldn't. They're not interested in the day-to-day transactions that you've been involved in. What they want to see is an overriding idea of the health of your finances. And the same principle applies in a wider sense to businesses. People like investors or our bank, they want to see how profitable a company is. They want to see the amount of liabilities that the company has. They want to see the health of the company's cash flows. They do not want to see the 50 transactions which took place on a certain day in a month. So summarizing information is key. So by now you should have got the idea that for a business to function effectively, it's really important that they keep track of all their historical financial data and transactions they've been involved in. And this is where our next topic, bookkeeping, comes into play. So of course transactions need to be recorded as they occur. And this is the role of bookkeeping. Essentially, it is the practice of recording monetary transactions for a business. And as it acts as a sort of financial history of the business, it is really important that bookkeeping is precise, accurate, and thorough. And if you can take a moment to think back to the 4 points above bookkeeping on the screen, I'm sure you can understand, you can realize why this is so important. More specifically, businesses use a practice which is known as double entry bookkeeping, and this involves recording 2 aspects to every single transaction that a business is involved in through a series of debits and credits. Now, this video isn't going to go into this topic in too much detail, so don't worry too much at the moment, but we will look at this in a later video. Finally, let's touch on the concept of stewardship. And before I go into this in a little bit of detail, why don't you just have a little bit of a think and maybe use some of the knowledge we built on previously to assess, to have a guess at what this particular concept might be to do with. So the concept of stewardship concerns an accountant's responsibility to the information and resources of the organisation for which they work. So if you think about this for a minute, accountants hold positions of real importance and authority within a business. Not only are they involved in presenting and recording the financial information of a business, they are also involved in the presentation of this material to external investors or banks. And of course, there are big decisions resting on the validity and accuracy of this information. And so, because of the pressure and the importance of their roles, it's crucial that accountants act professionally and ethically. And this is what the concept of stewardship really serves to highlight. So that concludes our first section. Let's zoom all the way out and move on to our next section,